My name is Asim Javed and I am a Senior Investment Manager with ABP Partners. We are a boutique discretionary fund manager based in the City of London with over 20 professionals, 600 million assets under management and over 100 years of experience combined experience in our investment committee. What makes us different is our risk-first investment process, and that we take the investment risk very, very seriously. And our asset allocation is dependent, our review formation is dependent on four-dimensional scorecarding system and with a quantitative bias. This is the first of the periodic videos which we'll be making, and some of them will be as an update, some of them will be a deep dive into our investment processes, and some of them will be educational and CPD oriented. Again, all will be aimed at our target audience, which is a professional advisor. Now, let's talk about what we've done in the last quarter. During the last quarter, we reduced our fixed income exposure to the long end of the yield curve and dialed down the duration to under 5 years. This helped us navigate the yield explosion we witnessed during the month of March, and also helped us manage the fixed income drawdowns. We also increased our exposure to the higher beta markets such as GEMS, the UK and Europe, and the reason for that was obviously the fiscal stimulus and the downstream effects of that fiscal stimulus on the higher beta markets. Then the COVID situation is turning positive in the developed markets, but it is not the case in the Southeast Asia, especially in India, as you must have been seeing and reading in the news that Indian COVID situation is quite bad at this point in time, and the vaccination in the Southeast Asia is a lot less than what is happening in the developed markets. This, of course, the reopening theme in the developed markets is a very positive theme for the equities. The danger of a new mutation is something which is very much alive, but we're keeping a close eye on that. The recent economic data points to a very optimistic picture. The purchasing managers indices, the CPIs, the unemployment rates, all of them are registering very, very healthy numbers in the US. So we look at that, and we're also expecting the Fed to take some policy decisions in the next few quarters. The problem with this at this point in time is the Fed's change in measurement has gone from the forward guidance to realized data, and the realized data is quite positive at this point, as we mentioned, and the averaging mechanism. So we're keeping a close eye on this and seeing what does that mean for inflation, and what does the positive data mean for inflation, and once the inflation runs hot, what happens then? As you know, the inflation is a very hot topic at this point in time, and we have maintained our stance since the start of the QE. That this level of liquidity will give rise to inflation later on in the period, towards the end of the QE. And as we go towards the reopening, that inflation the inflation story is coming very much alive now. But the Fed obviously wants the inflation to run hot, and if they're looking at the averaging mechanism, then obviously what does that mean for inflation right now? So as you can see in the chart, then the break-even numbers, the inflation break-even number is already, for 5 years and 10 years, is already in excess of 2.5. Does this automatically mean that the Fed will do a monetary tightening? No. This can mean that there is a change in some sort of approach towards the end of this year, Q4 probably. But we are still witnessing a very, very relaxed monetary policy at this point in time, but we are expecting some sort of change towards the end of this year if the inflation keeps running hot as it is. We remain vigilant, and we are keeping a close focus on the indicators as they unfold. This and the reading from the swap rate curve, as you can see in the chart, suggests that the Treasury's less than 10 years duration are expected to see a further increase in yield, and that's in line with what we're expecting in the break-even numbers. Anything which is above 10 years, it appears that the swap rate market is expecting some sort of compression in the yields in the longer duration. And that can be down to demand, that can be down to the pension funds buying into them, but that can also be down to the bond yields being higher than the earning yields on the indices such as NASDAQ. The probability what does that mean for the monetary policy? All we can say is at this point in time is that if the inflation runs hot or hotter than Fed's expectation, the probability of some sort of tapering or a monetary policy tightening sooner than what is expected through an FOMC dot plot is slightly higher. But the shape of that tightening or shape of that tapering is still unknown. So global equities in general and US equities in particular are priced to perfection, meaning the pricing mechanism offers little or no slack for any bad news. And again, this is technically the SPX index is an overbought position. Technically, the NASDAQ is an overbought position. And fundamentally, the cyclically adjusted PE ratios are in excess of 3 standard deviations for the US markets. And again, that's a deviation from its long-term mean. Usually you would expect some sort of reversion as soon as the CAPE ratio is in excess of 25. But right now it's sitting at 36. All of that is probably because of the excess liquidity in the market. One can easily argue that the unprecedented amount of liquidity and ongoing financial repression has pushed the prices up. Nonetheless, the CAPE ratio and momentum readings warrant caution from prudent investment managers. And that's what we are looking at this point in time. So what can we see for the next 12 months in terms of investment risk? So the way we form our views, we look at 12 months block every 3 months. And what we are looking at for the next 12 months, the inflation risk is alive. We're looking at the inflation risk and its effects on the monetary policy, and if there is some sort of tapering or a monetary policy tightening towards the end of this year. Equities remain a good place to be, but there can be a short-term correction. What is the quantum of that correction? We cannot say. But if there is a repricing in the bond market, that will spill over to the equity markets and will have an impact on the prices. However, medium term, we remain risk on, and that can be tied into the expectation for the US market or the US GDP to register around 6.5% this year in terms of growth. So again, the US market remains one of our favorite. The impact of ongoing central bank support for the markets and of course the onset of the fourth industrial revolution is an exciting moment for investors and is a sentiment we share, but within a well-managed and risk-first environment. Protecting investors' hard-earned savings is our highest priority. Stay tuned for more content and updates, and if you have any suggestions or questions, please drop us an email. We will be covering specific areas in the future, and if you have any thoughts on what you want us to cover, please do get in touch. Thank you.